Yeah, good morning, everyone.
Good morning.
I hope we are doing well.
Yes, sir.
Okay, that's good. All right, so once again, we thank God for for a day like this. So today we are going to continue our discussion again, and our discussion will be based on impairment of assets. Okay, our discussion is going to be based on the impairment of assets, and that is covered by the standard IFRS 36, impairment of assets. Impairment of assets. Right. Before we start, you have to know that all assets impair, all assets what impair, being a non-current asset, a current asset, all assets impair, provided there is no indicator for an impairment. So if there's no indicator for impairment, then it means that we can't carry out an impairment test on that particular asset. By inventory, cash, receivables, all of those assets what do impair. Okay. But in examination condition, they are going to tell you that you should assume that the carrying amount of those current assets that you have is the same as what their net realizable value. That's what they are going to tell you. It doesn't mean that receivables, inventory, and those ones, they don't impair. They also impair. The impairment for receivables is the bad debt. So if someone is owing you 10,000 Ghana cedis and you realize that, okay, the person is now in a cash problems and the person is not going to be paying you 5,000 of that particular amount. So you can see that the person being in a cash problem is an indicator of the receivables impairment. So it means that the 5,000, you're not going to receive it again. So the allowance, the bad debt of 5,000 can be termed as what an impairment of the receivables. A situation where you are going to be having an inventory or you are into buying and selling of softwares. So you have Windows 7. Now we have Windows 11. It means that if you have the package for Windows 7 over there, the invention or the introduction of the new Windows, which is Windows 11, is going to make the Windows 7 what maybe worthless or less what useful. So if you want to sell it, you are properly going to say below it what its cost, which will be the next realizable value. So there will be a reduction in the value of the Windows 7 as a result of the introduction of the Windows what 11. So you are properly going to say below what its carrying value, and that will be a reduction in the carrying value, or that will be where we have the next realizable value against what the cost, where we pick the lower of the two. So if you are selling the software, the Windows 7, if the cost is 10,000 because of the introduction of the new Windows 11 now, it's going to make that one less useful. So you are going to be selling that one maybe 8,000. The difference over there is an impairment. Why is it an impairment? You are selling this below its cost because of the introduction of what? The new Windows. So the introduction of a new Windows is an indicator for impairment of that particular inventory. So all assets impair, provided there is no what? Impairment indicator for them. All right. What is an impairment? And why do we carry out an impairment test? First of all, you have to know that impairment is not a yearly thing that you have to be doing. Okay, we only conduct an impairment test when there is an indication that this asset is there is a possibility that this asset will be carrying at a value which is higher than its recoverable amounts. What do we mean by recoverable amounts? If we should sell the asset right now, what is the value that we are going to realize from it? Or if we don't want to sell, we want to continue using the asset, what is the benefit that we are going to derive from using the assets? Discounted into the present terms using the what? The appropriate discount rates. Okay. So impairment is not yearly thing that at the end of every year you have to what? Conduct an impairment test. No, we conduct an impairment test on certain assets if there is an indication that this asset is likely to be impaired. But if there is no indicator for impairment, we leave it like that. So impairment is conducted based on the principles of prudence. Based on the principle of prudence. So we only carry out an impairment test on assets if there is an indication that this asset is likely to be impaired. All right. So the company acquired a car. The company acquired a car. Okay, let's see vehicle. Vehicle at the cost of 10,000 Ghana cedis. Okay, at the cost of 10,000 Ghana cedis, and they estimated that the useful life will be 10 years. Okay, they estimated that the useful life will be 10 years. What happens after using this particular asset for 2 years? The vehicle has now been what? Involved in an accident. The vehicle has involved in an accident. Okay, after the 2 years, the vehicle has been involved in an accident. So after 2 years, the vehicle has been involved in an accident. All right. So the question now is, if the vehicle has involved in an accident, it is likely that if you want to sell it today, if you want to sell it after the 2 years, it is likely that the carrying value, which is going to be the 30,000 minus 30 over 10 times 2, which will give you 24,000, which is the carrying value. It is likely that you are not going to sell the asset at 24,000 because of the accident. Okay, it is likely that you can sell it. If you want to sell it, you can sell it at 22,000 because of the accident. Because of the accident, people, they will not be willing to pay the what? The carrying value, or pay higher than what? The carrying value for this particular asset, because the asset might not be in what? Its original condition, or because of the accident, the efficiency of the car might reduce. Okay. If we don't want to sell it, it is likely that the benefit that you are going to be getting from the asset will not also be what? Be more than the carrying value. Because if the asset is involved in an accident, maybe the efficiency of the asset is going to be reducing. So if the efficiency of the asset is going to be reducing, it means that the asset is going to be giving us a less benefit for the future. So what if we don't want to sell the assets and we want to continue using it? What is the benefits that we are going to get from it? We discount the benefits which the cash flows to today, because we want to look at what is the amount that we can get from it today. So we discount that one to today. Then we compare and see whether the assets, we are carrying the assets at a value which is not higher than what? The recoverable amount. The recoverable amount is, if you want to sell the asset today, how much are you going to get from it? Which is the net realizable value. If you want to continue using it without sell, what is the benefit that you are going to get from it? Which is the value in use. So we compare the value in use and the net realizable value. The difference, so let's assume that this is the net realizable value, and the value in use, which is the what? If you want to continue using the asset, what is the benefit that it is going to give to you? And that will be 23,000. Okay. All right. So the carrying value of the asset is currently 24,000. If you want to sell it today, less of any cost to sell is 22,000. The benefit that you are going to get from the asset, if you want to continue using it, is 23,000. As a rational business person, which of these value are you going to use? Will you sell the asset right now or you continue using it? Are you going to sell it or you continue using it? If you want to sell it, the net amount is 22,000. And if you continue using it, the benefit that it will give to you is 23,000. Will you continue using it or you sell it? What will be your decision?
Yeah, continue using
You continue using the assets. Therefore, the recoverable amount, the recoverable amount, the recoverable amount is the higher of the value in use or the net realizable value. Is the higher of any of the two, value in use or recoverable amounts. So the question is, we are conducting or we are looking at if we are carrying the asset at a value which is higher than what the recoverable amount because of the accidents. So we are testing for an impairment because of the accident. We only test for an impairment of certain assets if there is what an indication of what a possible impairment. If there is no indicator, we don't conduct an impairment test. So if there is an indicator, what do? We ask ourselves, what is the current carrying value of the assets? And what is the recoverable amount? What is the value that we are likely to recover from the usage or from the sale of the asset, which is the recoverable amount? We compare the recoverable amount with the carrying value to see whether we are carrying the asset at a value which is not higher or which is higher than the recoverable amounts. So if there is an indicator of impairments, what we do is that we compare the carrying value with the recoverable amounts. So what is the current carrying value of the assets in the books? What is the value that we can recover from the asset, either through continued use or through outright what? So we compare the two. If the carrying value is lower than the recoverable amount, it means that the asset is not impaired. We just want to make sure that the asset is not carried at a value higher than what? The recoverable amount. So if the recoverable amount is lower than, if the carrying amount is lower than the recoverable amount, there is no impairment. So no impairment. No impairment. But if the carrying value is greater than the recoverable amount, then there is an impairment. So it means that there is an impairment. So the principle over here is that the assets should be carried at what? The lower of the carrying value and the recoverable amount. That is the principle over here. The assets should be carried at what? The lower of the carrying value and then the recoverable amount. So if the carrying value is lower than the recoverable amount, it means that the asset is not impaired. If the carrying value is greater than the recoverable amount, it means that we are carrying the asset at a value higher than what amount that we can realize from the asset through sale or the continual use. So there will be an impairment of that particular asset. What you have to know is that impairment of asset is basically, this standard is basically for asset carry under cost model. Because asset carry under cost model, the asset is being carried at a historical cost. We don't do anything again. So it is likely that maybe we are carrying the assets at a value higher than the recoverable amount. But asset carry under revaluation model, asset carried under revaluation model, you see that asset carry under revaluation model, you see that at the end of every year, we fair value the assets. At the end of every year, we fair value the assets. So you can see that automatically we do the impairment for this particular asset. And the impairment for this particular asset is the revaluation loss. So the impairment, to a larger extent, it is basically for what? The asset carry under cost model. All right. So let's look at how do we calculate impairment? How do we calculate impairment? Okay. Whenever there is an indicator that the asset is likely to be impaired, you take the carrying value of the assets because you want to compare if you are not carrying the asset at a value higher than the value that it should have been carried. Okay, so you get a carrying value of the assets, which they will not give to you in the exam. You have to calculate it. Okay, using the principles of IFRS 16, property, plants, and equipment. How do we calculate carrying value? It is the cost less accumulated depreciation up to the date that you are looking for the carrying value. Okay, then you now take the recoverable amount. Okay, the recoverable amount is the higher of the net realizable value or the value in use. What is the net realizable value? Assuming you want to sell the asset, the market value of the asset is what? Is 20,000. But before you can sell this particular asset, you have to engage an agent who is going to look for a buyer for you. So it's an agent that is going to assist you in looking for the buyer, and you are going to pay the agent 1,000 Ghana cedis. So after selling the asset for 20,000, you are going to give the agent 1,000 Ghana cedis. It means that the net amount that you are recovering from the sale is 19,000. Although you sold the asset for 20,000, you are giving 1,000 out of it to the agent. So the amount that will be left for you is the 19,000. So the net realizable value is the fair value less cost to sell. So the fair value is the 20,000. The cost to sell is the agent fee or the commission that you are paying to the agent. The cost to sell can be a transportation. The cost to sell can also be a transportation. Any cost that you are going to incur to sell the asset is what we call the cost to sell. So if we take the cost to sell from the fair value, we have what we call the net realizable value or value in use. The value in use is if you don't want to sell the asset and you want to continue using it, what is the benefit that the asset is going to derive or is going to generate to the company over the remaining useful life? So if you don't want to sell it and the asset is having a remaining useful life 4 years now, if you continue using it for the business, what's the benefits? What's the economic benefits that this particular asset is going to give to the entity? So you look at the cash flows, you discount them at the appropriate discount rates. Then you compare with the net realizable value. So what do we use? The cash flows that you are going to have over here, the cash flow over here should be a pre-tax cash flow. Okay, should be a pre-tax cash flow. It means that there should not be any element of tax on it. There should be a pre-tax cash flow. Okay, the discount rate that you are going to be using should be a pre-tax discount rate. So the discount rate should be, the discount factor should be a pre-tax discount factor. Okay, so the discount factor should be a pre-tax discount factor, and the cash flow should be a pre-tax cash flow. This cash flow should be excluding any enhancing activities. So maybe before you can get this particular cash flow, you have to improve the condition of the assets to be able to get this particular cash flow. So maybe in the first year, you are going to be getting 20,000. But before you can get the 20,000, you have to carry out a maintenance cost on the asset at 2,000. Okay, so the cash flow that you are going to be using will be 18,000. So it means that before you can get the 20,000, you have to You have to carry out a maintenance. So you net the cost against the cash flow, then you use the net amount. So the cash flow should be excluding any enhancing activities, any enhancement of the asset activity. So if there is any cost that you are going to incur to generate that particular cash flow, the cost must be net against the cash flow. That's what we are saying. Should be excluding any enhancing activities. It should be excluding any enhancing activities. Okay. The standard says that the cash flow should be for maybe the projection of the cash flow should be based on the current budget, and it should be based on reasonable what assumptions. So the cash flows, the estimation should be based on the entity's current budget, and it should represent the cash flow should represent reasonable assumptions. Okay, the standard says that the cash flows that we can be able to use should be maybe cash flow for the next 5 years. So any cash flow that is going to be beyond 5 years. So if the cash flow is the first year, you are saying that is 20,000, 2 is 40,000, year 3 is 60,000, year 4 year four will be maybe 85,000. Year 5 will be maybe year 5 should be maybe 90,000. Okay, they are saying that it is the first 5 years cash flow which is somehow relevant, but any cash flow that will go beyond the 5 years, maybe the cash flow should experience a decline at a constant rate. So it means that if yes, you want to have year 6 can be this one, it will not go, it cannot increase above 5 years. So year 6 can be maybe 60,000. Year 7 can be 50,000. Year 8 can be 40,000. So there will not be, the cash flows cannot experience any further increase, or it can be 90,000 throughout, or it can be lower than 90,000. All right. So the cash flows, we use the pre-tax cash flows, and the discount rate that we are going to use is pre-tax discount rate. There should not be any tax element on it. Why are we not having the tax issue? The cash flows is likely to be a revenue which should be taxed. But why are we not using post-tax cash flows? We are using pre-tax. You see that there is a different standard on income tax, which is the IS12. So if we want to know the tax, it is not that the tax is not the company's tax rate, which is 30%. For us to determine the tax that we are going to take to the income statement of a company, we have to subject this particular tax to the provisions of 12. So 30% is not the appropriate tax that we are going to pay. So there might be under provisions, there might be over provisions, there might be issue relating to deferred tax. So in that case, let's just use the pre-tax and we move on. Okay. So we are saying that at the date of an impairment test, even that is if there is an indicator, what do we do? If there is an indicator, what do we do? We compare the carrying value with the recoverable amount. And we say that the recoverable amount is the higher of the net realizable value or the value in use. We pick any of them. If there is an impairment, how would the impairment be treated? The accounting treatment. The accounting treatment. How would the impairment be treated? Okay. If there is an impairment is a loss. So what will happen is that we debit profit or loss, then we credit the asset. It means that we have to reduce the value of the asset. So we debit profit or loss. So if there is an impairment for the first time, the impairment will be taken to profit or loss as an expense. Then we reduce the value of the asset by the impairment. So the asset will now be carried at the recoverable amount. So we reduce the value of the asset by the impairment. So that is basically about the initial treatment of an impairment on a single asset, on a single asset. So if there is an impairment, the impairment will be taken to profit or loss, and the impairment value will be used to reduce the asset to the carrying value. Okay, the standards, we are going to look at impairment of a single asset. Okay, a single asset, that is it. We are going to look at what we call a cash generating unit. We look at maybe reversal of an impairment, corporate asset, then we are done. Okay, let's look at, there are certain assets. Even if there is no indicator for an impairment. Okay, the indicators for an impairment can be external or it can be internal. Look at them. Look at them. Look at them. The government legislation, maybe the change in the demand for the product that the company is using the asset to produce. Maybe technological changes can also, maybe there is a new or there is an updated version of the asset, or there is a new asset that is going to make that one useless. It can also be the increase in the market interest rate, because we are going to use the interest rate to discount the cash flows. So if the discount factor is increasing, it means that the value in use will be reducing. So that can also be an impairment. That can also be an indicator of impairment. Internal one is what? Maybe the asset has physically damaged, or the company is now trying to what? Change the usage of the asset. What they are using the asset for, they want to use it for a different thing. So the question will give you the indicator for the impairment. So you can read about that one. All right. There are certain assets, whether there is an indicator or not, there might be what? Tested for an impairment annually. And these particular assets, the first one is intangible assets. Intangible assets with indefinite useful life. So you are going to have an intangible asset with indefinite useful life. They must be tested for an impairment. So they can ask you, what are some of those assets? Or the IAS 36 has suggested that there are certain assets that must be subjected to what? An impairment annually, whether that is an indication or not. And the first asset is the intangible asset with indefinite useful life. The next one is what? Goodwill acquired through business combination. So goodwill acquired through business combination. So the goodwill acquired through business combination, which is going to be calculated as the purchase consideration minus the fair value of the company's assets. The difference, which is the goodwill, must be subjected to what? Annually impairment test. This one, we don't consider a condition. No, if there is an indicator for impairment or not, it must be subjected to what? Annually impairment what? Test. Let's pick a question for a single asset. Then we look at what we call a cash generating unit.
Good morning.
Yes, you know.
The topic, the one we are treating is impairment and the revaluation.
Yes, please.
Yeah, thank you.
Okay, so we are going to solve a question on revaluation, and also maybe on a single asset. Mhm. Okay, let's look at the question 2. because I don't want to, I want us to finish early. So I don't want to take a question that is going to take our time. So let's take the question 2. So I want to read the question 2 for us.
Due to a change in Pusiga Limited's production plan, an item of machinery with a carrying value of 11 million at 31st December 2017 may be impaired due to change in use. An impairment test conducted on 31st December 2017 revealed its fair value less cost of disposal to be 5 million. The machine is now expected to generate an annual net income of 2 million for the next 3 years, at which point the asset will be sold for 2.4 million. An appropriate discount rate is 10%. Pusiga charges depreciation at 20% on reducing balance method on machinery. Note, the present value of ordinary annuity of 1 CD at 10 for 1 year, that's a discounting rate required. In accordance with IFRS 6, explain with justification the required accounting treatment in the financial statement of Pusiga Limited for the year ended 31st December 2017.
Okay, thank you. So the issue now is for you to solve any question on impairment, you first have to ask yourself, what is the date for the impairment? At what date are you carrying out an impairment test? When are they conducting the impairment test? What date? I'm sure, if I'm not lying, I'm sure that will be 31 December 2017. Okay, so at this date, you have to ask yourself, what are we looking at? When do we say asset has impaired? We say that asset has impaired when the carrying value is higher than a recoverable amount. So as at this date, which is 31 December 2017, what is the carrying value of the asset? That is the first question. What is the carrying value of the asset? The carrying value of the asset given to us is what? 11 million. It means that they have charged the depreciation of that particular one to the year already. So we don't have to calculate the carrying value ourselves. So the carrying value here is what? 11 million. Okay. Then you ask yourself, if the carrying value is 11 million, what is our recoverable amount? We say that the recoverable amount is the higher of the net realizable value or the value in use. So the net realizable value given to you is 5 million, which is what? The fair value less cost to sell, which is what? 5 million. The question now is, can we determine the value in use? If yes, then we determine the value in use and compare the value in use with the net realizable value to pick the highest one. So we have to determine our value in use. And they are saying that the machine is now expected to generate what? Annual net income of 2 million. So it means that every year the company will be giving us a net income of, the machine will be giving us a net income of 2 million for what? 3 years. And at the end of the 3 years, we are going to sell it for what? 2.4. So the question is, what are the benefits? If we should continue using the asset, what will be the benefit that the company is going to generating from the continued use of the machine? The company will be receiving 2 million as a net income for 3 years. And at the end of the 3rd year, they also receive a benefit of 2.4. They are going to sell it at 2.4. So if you are discounting the cash flow or the relevant cash flows, the residual value at the end of the useful life of the asset is also part of the cash flows. It's also part of the benefits. You'll be receiving a net income from continued use. After the 3 years, you sell it for what? 2.4. That is also a benefit that the company or the asset is going to give to you if you should continue using it. But if you want to sell it over today, it means that the residual value will not be what? Given to you, because you can only realize the asset if you finish using it and you have to dispose it. So the cash flows will be the net cash flows based on a continued use, and any other what? Cash flows that will be through a sale. So residual value should also be considered if you are calculating for the cash flow. So let's take that one and determine whether the asset has impaired or not. So question 2, which is the Pusiga Limited. So we take the carrying value, which is at 31 December 2017. This is the date of the impairment test. So what is the carrying value? We look at the carrying value. Carrying value is 11 million. What is the net realizable value? It is 5 million. So we have to determine the value in use. So the value in use has to be computed. So we do it like the normal cash flow. So we have the years here. We have the cash flow. We have the discount factor, which is 10%. And we have the present value. Okay. So the years, we can use annuity. So year 1 to year 3, we are going to be having a cash flow of 2 billion. So it means that year 1 to year 3, we are going to be having a cash flow of what? Of 3 million. So if you like, you can do it one by one. But me, I'm going to use annuity because of the what? The time. And they have the question was even generous by giving you the discount factor. So you can see that they have given you the annuity factors. So the annuity for 3 years is 2.84. They can say that they are giving you 1 cedi. It's just like the annuity, which is the one that we normally use. Okay, so for 1 cedi right now, this is what? The first year is 0.909. Second year is 1.736. Third year is this one. This is just an annuity factor for the cash flows. So it is 2 points. I will just pick the 2.487. So in the third year, what will happen? We are going to sell the assets and receive the what? The residual value or the scrap value of 3.4. And this will be received in the third year. So we use a discount factor for the third year, which is given to us over here, 0.751. 0.751. So we pick the 0.751. 0.751. Okay, so what will be the cash flows now? What are you having? The present value. 2 multiplied by 2 points. What are we having? 2 multiplied by 2.487 and 2.4 multiplied by 0.751. What is the figures? Fast. What are we getting?
6.78.
6.78 for the first one.
No, the first one is 4.974. The 6.78 is the total.
Is a total. Okay, so let's take it one by one. So the
4.974.
4.974. Okay. And the last one is
1.806.
1.806. So we're having
6.78.
78. So the question is, which value are we picking as the recoverable amount?
6.78.
Okay, we pick the higher of the net realizable value or the value in use. So our recoverable amount is now 6.78. So let's test for the impairment loss. So impairment loss will be calculated as the 11 million minus 6.78. What will be the impairment?
4.22.
4.22 million. So what is the question saying? Let's look at the requirements of the question. So the question is saying that in accordance with this one, explain with with justification the required accounting treatment in the statement of what? Pusiga Limited for the year ended this one. The explanation is you can't explain without calculations. Okay. So what will happen is that the change in use of the asset is an indicator of an impairment. So the company now has to determine whether they are carrying the asset at a value higher than what? the recoverable amount. How do we determine the recoverable amount? The recoverable amount is the higher of the net realizable value or the value in use. But in the question, the net realizable value is 5 million, and the value in use must be computed using the cash flows. So we have computed that, and that is 6.78. So the assets, we must what? Carry out an impairment test by comparing the carrying value to the recoverable amounts. If you do that, you see that there will be an impairment of 4.22. So this 4.22 should be charged to profit or loss for the year and should be used to reduce the value of the asset. So in the statement of profit or loss, okay, we are going to be having an impairment loss of 4.22 as an expense. In the statement of financial position, the asset will be carried at the carrying value, which is the machine. It will be carried at the recoverable amounts rather, okay, which will be 11 minus 4.22, and that will give us 6.78. Okay, so this is just following the principle. The asset should be carried at the lower of the cost and the net realizable value or the recoverable amounts. So that is about that particular one. Let's pick a question on the revaluation of an asset. Revaluation of an asset. Okay. Let me see whether I have a question on that. Okay, so we are saying that the cash flow should be pre-tax cash flow, but sometimes they can give you the company might be in a different what country. The asset must be in a different country where you have to use a foreign currency. So you discount the cash flows in the foreign currency. Then after that, you translate it as the spot rate to this particular one, which is the question that we have over here. So I will try to see if we can deal with that question. If we can't deal with it, then we move on to like this, the question 8 over here. But if you can't deal with it, then I'll just bring it in the in maybe revision time. Okay.
Let's do that question.
So let me check if I can have. I want to finish impairment today, so I don't want to pick a question that will consume my time. Okay. So,
That question don't fit to consume any time. Let's do.
so let me see. So let me see. All right. I'll solve that one as the last question. But let me finish what I want to do. Yes. I want to see if question this one. And, let me see whether I can pick the one or two. Okay. So let me see which of them that we should pick. Okay. Let's pick the two. Let's pick the two. Let's read the question 2 over here.
BI owns a building. BI owns a building which it uses as office, warehouse, and garage. The land is carried as a separate non-current tangible asset in a statement of financial position. BI has a policy of regularly revaluing its non-current tangible assets. The original cost of the building in October 2022 was 1 million. It was assumed to have a remaining useful life of 20 years at that date, with no residual value. The building was revalued on 30th September 2024 by a professional valuer at 1.8 million. BI also owns a brand name which it acquired 1st October 20X0 for 500,000. The brand name is being amortized over 10 years. The economic climate had deteriorated during 20X5, causing BI to carry out an impairment review of its asset. At 30th September 20X5, BI building was valued at a market value of 1.5 on 30th September 20X5 by an independent valuer. A brand specialist valued BI's brand name at market value of 200,000 on the same date. BI management accountant calculated that the brand name value in use at 30th September 20X5 was 150,000. Required. Explain how BI should report the event described above and quantify any amount required to be included in its financial statement for the year ended 30th September 20X5.
All right, thank you. So the reporting date, the date that they are asking us to do this is 30th September 2X5. Okay. But we have to do certain things before we give a report on how they should account for these particular items. You see that the building was acquired on what? First was acquired, let's assume that it was 1st October 2X2. Okay. You have to be very careful with the reporting date of the company. The reporting date of the company is likely to be, or it is what? 30th September. Every year is 30th September. Okay. So the building was acquired on 1st October 2X5. You can see that the building has a remaining or has a useful life of 20 years. Okay. With no residual value. The building was revalued on 30th September 2X4 by a professional valuer at a value of what? 1.8 million. All right. The question now is, we have to first calculate for the revaluation surplus or loss on the building before we come to what will happen on 2X5. Okay. The building was acquired on what? 1st October, and it was revalued on 30th September 2X4. Okay. Let's now come from 1st October 2X4 to 30th September, from 1st October 2X2 to 30th September 2X4. How many years is that? How many years is that?
2 years.
Okay. So we have to find a revaluation surplus on that particular asset. Okay. So we look at question 2, which is the BI. Okay. So let's calculate the revaluation surplus on that particular asset. The revaluation surplus is calculated as the revalued amount minus the carrying value. Okay, so the revaluation surplus is calculated as the 1.8 million, which is given to us, minus the carrying value of the asset. How do we calculate the carrying value of the asset? It is the cost less any accumulated what? Depreciation. So this will be calculated as 1 million divided by 20 times 18. That is the carrying value. Think about it. Is that correct? The carrying value is 1 million divided by 20 times 18. Okay. You see that if you are calculating the carrying value, you take the 1 million and take 2 years depreciation from it. So it means that 20 years is the full value. So if you are taking the accumulated depreciation of 2 years from it, it means that you are now reducing the carrying value to 18. So that the carrying value can also be calculated like this. But if you like, you can calculate it the normal way that you know, which is the what? The 1 million over 20, or the 1 million minus what? The depreciation for the 2 years. Okay. So our revaluation surplus will be calculated as 1.8 million minus what? What will be the carrying value?
Carrying value should be 900.
Okay. That will be 900,000. Okay. So what will be the revaluation surplus now?
900.
Okay. So we have a revaluation surplus of 90,000. Okay. The question did not say that. So this would go to other comprehensive income for the year ended 30th September 2x4. So for the subsequent years, our assets will now be carried at the revalued amounts. Okay. So let's now come to what will now be the value of the assets at 30th September. Okay. So they are asking us to do at 30th September. So what is be the value of our asset at 30th September? We have to know that our building will now be carried at the revalued amount. So from 1st October, from October 2x4, okay, from October 2x4 or 2x2, let me check which of them. When was the distance down? Okay, 2x4. So from October 2x4 to the remaining useful life of the assets will be carried at what? 180,000, 1.8 million, which is the revalued amount. Okay, but they are now saying that they have conducted an impairment on this one and the asset has been revalued again. So let's look at what will happen. Okay, so the building house revalued at the market value of 1.5. So this was done on 30th September. That is maybe just a year after the revaluation. So from 2x4, the asset will be carried at the revalued amount, which is 1.8. So 30th September 2x5, that is just a year after the revaluation. So let's now look at the carrying value of the assets now. So let's look at the carrying value of the assets. Carrying value of the assets will be the cost minus the accumulated depreciation, which is just a year depreciation. So we can say that the carrying value is equal to the 1.8 million minus into brackets, the 1.8 million divided by the remaining useful life, which is 18 years. Okay, that will give us 1.8 million minus, would that be 100,000?
Yeah.
Okay, so the carrying value will be 1.7 million. Okay, but the question is, as this date, what is our revalued amount? What is our revalued amount? Our revalued amount is 1.5. Our revalued amount is 1.5. Okay, so we have the revaluation loss. The revaluation loss will be the 1.7. The 1.7 minus the revalued amount, which is 1.5. And it says that the carrying value is 1.7 million, but our revalued amount in the market, or our value of the asset in the market, is 1.5. It means that we are carrying the asset at a value higher than the recoverable amount, basically. And the revaluation loss will be 200,000. Okay. But this revaluation loss, which is an impairment loss, basically will be treated in accordance with what the IAS what 16. So the question is, were there any previous revaluation relating to that particular asset? Yes, which what results in a revaluation surplus of what? Of 900,000. But we are also experiencing a revaluation loss of what? 200,000 now. It means that the net gain on that particular asset should have been 700,000, not what? 900,000. So what we do is that this revaluation loss will go to other comprehensive income to cancel the first what? 900,000 gain that we have, because the gain can actually take care of all the loss. So we send all the 200,000 to other comprehensive income to net what? The previous what? Revaluation gain of 900,000 to 700,000. But assuming if the revaluation surplus over here was 180,000, we send only the 180,000 to other comprehensive income and send the difference of 20,000 to profit or loss, because the gain on the revaluation surplus, which is the other comprehensive income, is only 180,000. So we can only remove the 180,000. But the remaining 20,000, where will it go? We send it to profit or loss. If the previous gain cannot cancel all the what? The subsequent loss. That's how we treat it. The portion of the loss that is in the other comprehensive income, we send it there. The excess will be sent to profit or loss. But in this case, the 900,000 can take all the what? The 200,000. So this will be sent to other comprehensive income. Let's now look at the brand. This is for the building. Let's look at the brand now. Let's look at the impairment relating to the brand. Okay. The impairment relating to the brand, we have to look at the carrying value of the brand and the recoverable amounts. So let's go to the question and determine when the brand was acquired. Okay. The company also owned a brand which it acquired on 1st October 2X0 for 500,000. The brand name is being amortized over 10 years. The economic climate has deteriorated during 2X5, causing the BI to carry an impairment review of its assets at 30th September 2X5. The question now is, from 1st October 2X0 to 30th September 2X5, how many years is that? How many years will be that?
5 years.
Okay, that will be 5 years. So it means that we have to determine the carrying value of the brand as 30th September. How do we do that? We have to take the cost and take 5 years amortization from that. So the carrying value, we have already used 5 years, remaining 5 years. So let's determine the carrying value of the brand as this particular date. So the carrying value, we all know, is calculated as the cost minus the what? The accumulated amortization. This will not be depreciation because it's a brand. So accumulated amortization. Okay. So the carrying value is the cost, which is what? 500,000. Then minus what? The 500,000 over 10 years times 5. Okay. So we have the carrying value will be equal to the 500,000 minus 250,000. Am I correct? So the carrying value will give us 250,000. Is that correct? Okay. So someone can also determine the carrying value as the cost over the useful life multiplied by the remaining useful life. So someone can also determine like that, the cost over the useful life. So the cost over the useful life is the annually amortization. We have done 5 years already. It means that it is remaining 5 years amortization. So 5 years amortization, what is the total? Every year is 50,000. So what is the portion left that should be amortized over the remaining 5 years. That will be the 50,000 times 5, which is give us the 250,000. Okay, so that is the carrying value. Let's now go and determine our recoverable amounts. What is the question saying about the recoverable amounts? Okay, a brand specialist valued the BIS brand name at a market value of what? Of 200,000. Okay, this is the what? What is this one? What will be the name? In determination for recoverable amount, how are we going to name the 200,000? How are we going to name the 200,000? The BS management accountant calculated a brand value in use at this one to be. So this is a value in use, but the 200,000 over here will be named as
Net reservoir value.
okay, net reservable value. So we assume that the cost to sell over here is 0. Okay. So the question now is the net reservable value is 200,000 and the value in use is 150. Which of them are we picking?
200,000.
Okay. So we pick the higher. So our recoverable amount is now recoverable amounts. So let's determine our recoverable amounts. The recoverable amount will be 200,000. So the question is, what is the carrying value? It's 250. The recoverable amount is what? 200,000. It means that there is an impairment. There is an impairment loss of 250 minus 200,000. And that will give us 50,000. So impairment loss relating to this one is this, and this will go to profit or loss. Okay, so if you go to statement of profit or loss for this year, we are going to be having an impairment of 50,000. Then if you come to the statement of, in the same statement of profit or loss, we are going to have other comprehensive income. Then you have the revaluation loss of 200,000. If you go to statement of financial position, you are going to be having a machine at 1.5 million, which is now the new revalued amount. And you are going to be having a brand at 200,000, which is the recoverable amount. So this is basically about a single asset. So we go for some 5 minutes. By 5:20, we should be here so that we look at the what we call cash generating units. While we reverse an impairment and what we call a corporate asset. If you're able to look at this within some time, then we look at the question that our brother was saying that we should look at. So let's go and come. 5:20, we are going to come back. Then we look at cash generating units, which will not take 5 minutes. Reversal of impairment, corporate asset. Then we know that we are done with impairment. Impairment is not something that we should do for every 2 days now. All right.